So I'm very pleased to host this panel today on this very interesting topic, as we have three excellent speakers with us who represent, or rather who are affiliated with different types of institutions across the globe, and will hopefully share their views with us on, be it from the policy perspective or from their research on these topics, on the macroeconomic and financial stability considerations of climate change for central banking. So let me first introduce the speakers, and then let me explain the format of our discussion. So to my left is Fernanda Nechio, Vice President at the San Francisco Fed, who previously held the position of Deputy Governor at the Central Bank of Brazil. To Fernanda's left is Margarita Delgado, Deputy Governor of Banco de España, and to her left is Harrison Hong, Professor of Financial Economics at Columbia. So the format of this session will be here for 60 minutes. First part of the discussion will be presentations by the speakers. I think you've prepared some slides. So Margarita, we can start from you if you like. And afterwards, we'll take some questions from the audience, and we hope to have this as interactive as possible, so please feel free to already start thinking about potential questions. So thanks, and the floor is over to you, Margarita.
Thank you very much. Good morning, everyone. And thank you, of course, for participating in this closing panel of what I hope has been a very productive and successful conference. Well, many key topics to central banks nowadays. I hope that the presentation on the slide deck will be uploaded. Here it is. Thank you. I think you've covered many topics during these 2 days, but today, of course, I mean, we have another big and challenging topics. First of all, let me just say that the green transition poses substantial challenges for the economy and for the financial system, of course. And central bankers, here we are taking a growing role in our activities and within, I mean, of course, our mandates. But let me be very clear. First of all, I believe that governments must lead the green transition process. I think they have the democratic legitimacy to do that, to establish a roadmap, and they have probably the most suitable set of tools to achieve the proposed targets. For instance, we've said already precisely in our annual report that in Spain, it is essential to strengthen the environmental taxes and to boost public investment, while at the same time, of course, deploy a kind of offsetting and temporary measures targeted to the ones more impacted by the green transition. Also, governments are responsible for setting the environmental standards to enhance regulation of economic activity, to provide economic agents with a kind of certainty and a stable operational framework in these really very extraordinary, uncertain times that we are living. Of course, and finally, let me also be very clear about the financial system, which is very close to my heart. I think the financial system is a really key player in the transition towards a more environmentally, let's say, sustainable economy. There will be an enormous amount of money, of funds, funding required, and these funds should be really very efficiently channeled to make this transition possible. So the role of financial supervisors and regulators really, need to ensure that all participants in the market, in the financial system, really identify, manage, report, they are transparent, disclose, and also they are able to really price, the situation into their operations, right? So everything should be factored into the risk management function and risk management systems. And this is really important to me. We've just listened to a previous presentation by Rafael, about the data gaps in the green transition. This is also a crucial point. It's not a question only of the taxonomy or not. It is a question of having, let's say, more granular data, more with historical data that are comparable and are more or less, let's say, confiable, if I may say so, right? So there are many initiatives around it. Maybe just in the European camp, we have the CSRD, the ITS of the EBA, or of course at global level, the works, as mentioned before, of the NGFS. Also the creation of the International Sustainability Standards Board back in 21, it's really a kind of great milestone for the future. And let me also mention the need for having assured or traceable or audited financial information, not only for the financial firms, but also for the corporates as well. So let me now focus on central banks. I've prepared a short presentation after these initial remarks. I will try just to focus on a couple of topics per slide. I mean, this is probably, let's say, the whole picture that we've prepared for today's presentation. This is just, I mean, the areas of work in which a central bank, such as Banco de España, we are working on. So there you have, from the monetary policy to the economic analysis and research, of course, financial stability, as I said, banking supervision and regulation, and of course, I mean, our own investment portfolios, corporate sustainability, of course. So let me just pick up a couple of elements of each of these 6 elements. First of all, of course, monetary policy. Within our mandate, the Governing Council already approved back on July the 4th to take further steps to include the climate risk consolidations in the Eurosystem monetary policy framework. Indeed, I mean, the Governing Council decided to adjust corporate bond holdings in the Eurosystem's monetary policy portfolios and its collateral framework to introduce climate-related disclosure requirements and to enhance its risk management practices. If you want to go deeper, of course, you can read the slide, but in order not to be very boring, let me just try to pick up one element. Beyond all those elements that are listed there, 1, 2, 3, 4, maybe linking to what Rafael was just mentioning, the risk assessment and management, I think that the ICAs here, I mean, in order to prepare the risk assessment tools and capabilities, they are now starting to introduce the climate-related risks. I think we have agreed on a set of common minimum standards for how national central banks within the Eurosystem and their in-house credit assessment systems should include climate-related risks in their ratings. These standards will enter into force by 2024. At Banco de España, we have already started to use text mining in our ICAs and natural processing language, and we have started to, of course, I mean, to reap, I mean, our fruits. But still, I mean, yet this counts on a very tiny part of the final rating, but we have started together already. And also to mention that the non-financial disclosure information obligations kicked in last December, and now we are trying to gather all the non-financial information from a very big portion of companies, not only financial firms, but also corporates in Spain, beyond whether they are, I mean, whether they are listed or not. This is a tough and very difficult task, but of course, this is the starting point, and we have started already. If we move on to the next slide, maybe just a zoom on our efforts to have a better understanding of the impact of climate change and into the economy, and which is already included in our analytical and research priorities for this year. Let me just say a few words on that. This has been already presented in our annual report back in May, but it is clear that there is an asymmetric impact of climate change in the different sectors, households, and firms in Spain. This is clear. And of course, I mean, as an example, I mean, what is represented in the slide, let me highlight a couple of remarks. We know that, of course, that different sectors of the economy are differently exposed to physical and transition risks. We have also found that within each sector, the smaller firms are the ones less prepared. So SMEs and self-owned companies are less prepared than bigger companies. In last year, in the last part of 21, Banco de España surveyed Spanish firms on their view on how climate change and transition might affect them. A large majority of the smaller firms have still not assessed the impact that the climate change will have in their activity. And of those that really analyzed and carried out this assessment, the percentage of small firms, SMEs, that expected a negative impact was almost 8 percentage points higher than among the larger firms. So if you look at on the right-hand side of the slide, of course, I mean, the chart on the left, let me just clarify, you can see that among the main risks, it is, of course, the higher inflationary potential pressures and greater administrative burdens due to the new disclosure requirements are the ones that really raise concerns to companies. Also, if we move on to the right-hand side of the slide, and we have learned that, the expected and foreseeable increase in the prices of more polluting goods over the coming years will probably have greater impact on lower-income households and on those whose household reference person is aged between 35 and 45 years. Also those living in rural areas and with lower education and in larger households. So if you want to go deeper, of course, you should go to our annual report, but of course, just through surveying or just analyzing granular data, there is a lot to do in this front. And of course, for researchers, I think this is very interesting for the future. If we move on to the area of financial stability risks, of course, sensitivity analysis and stress testing, it's a kind of one of our major policy areas for us, given that the risks of climate-related risks are really, uncertain by nature. We've done stress testing, a green stress testing back it was published back in November. And the conclusions is that, of course, there is an impact, but somehow it is still quite moderate in terms of, an increase of probability of default of the different corporates. You know that we have a very granular, credit register, and picking up from the different sectors and being very granular in the different sectors of the economy of Spain, we can really go deeper and have very specific and important and relevant outcomes of the Spanish banking sector. In terms of banking regulation and supervision, well, something was already mentioned by Rafael in the previous presentation, but of course you have the different prudential treatment, Pillar 1, Pillar 2, and Pillar 3. For those that are not really familiar with these names, Pillar 1 is the capital required for the exposures to the bank. Pillar 2 are additional capital requirements that are not covered in Pillar 2, usually set up by supervisors. And finally, Pillar 3 is just disclosure. This is very relevant because this is not, let's say, neutral. The weighting of the different risks are not neutral. How the regulators and supervisors really impact on the weights might have impacts on of course, on the lending activity of the bank. So a lot is going on in the different regulation and authorities, from the Basel Committee to the EBA, and of course also at a local level. And so far, I think more work needs to be done. Currently, we've just conducted a stress testing which was published back in July, and without any capital requirements impact. We are still, of course, analyzing and discussing internally how to move on and how to go forward. And finally, of no less importance, let me just clarify that, central banks have also additional responsible investment principles for the non-monetary policy portfolios. So I think we have already embedded climate sustainability considerations in our own operations. But of course, we back in 2019, as it is mentioned in the slide. But of course, we will continue working on and moving on. And maybe just very quickly, the corporate sustainability, because we have a kind of manufacturing side of our activities. So we have established and set up a unit in charge of all these, more physical things related to sustainability and environmental compliance with all the rules. And with that, I think I took a lot of time. Sorry about that, but we have a lot of elements within a central bank. Thank you.
Thank you very much, Margarita. A very comprehensive summary of what is happening in the Euro system. So I think it will be now very interesting to hear from Fernanda, her experience at the San Francisco Fed.
Thank you. Well, first I would like to thank Rafael for inviting me to participate on this panel. This has been a great conference overall, and the discussions here today are very informative. Are my slides up? Can I don't know how to... Well, so what I'm planning to do today while they're uploading my background slides is to touch on 3 points. First, I'll start by giving you some very basic statistics about how climate has been affecting the US economy. And this is basically going to be, basic stats on climate related shocks and the effects on the US. And then I'm going to go into one topic that as much as I think that I don't need to talk about it again anymore, it's usually the case that I do have to talk about it again over and over, which is why central banks are talking about climate. And then the third thing that I'm going to do is to talk about what the San Francisco Fed has been doing on this effort, on the efforts related to climate risks and the effects on the economy. So starting with some statistics about climate shocks in the US, this picture is giving you the number of climate-related shocks that are more than billion-dollar disaster events. And you can see that those have been increasing quite a bit in the time series that we have in this picture. Not only the number has been increasing, but also the costs financially of these shocks. So these are only billion-dollar disasters, and you can see that the trend kind of has changed over time quite significantly. So what do we take from this? Well, we see that this has been rising concerns for both US consumers and businesses. So we have been seeing in surveys that not only households are worried about climate shocks, climate events in general, but also that businesses are raising these concerns more frequently. We hear that from their reports, from their meetings and talking to investors, and also how they have been approaching these risks and shocks in their decision-making in their own businesses. So we are seeing a number of events, an increasing number of events. We are seeing the cost of these events going quite large and increasing over time. And we are seeing rising concerns among consumers and firms in the US. So then I go into my slide that I think I never have to talk about anymore, but I do have to talk about it, is why do central banks need to monitor climate risks? So this seems like a question that for, at least in Europe, you wouldn't have to touch upon, but it was only yesterday during the reception at the Bank of Spain in which I was approached by an economist, a young economist, and he told me that central banks had nothing to do with this. And when I told him that I was working on climate-related topics, he gave me a long spiel about how central banks have been overreaching, and this is not a topic for central banks whatsoever. And I think the 3 slides that I showed you before are actually proof that he's wrong, right? I mean, to the extent that climate shocks and climate risks are affecting the economy, in the US economy or the European economy or economies overall, this is a topic that central banks need to monitor and understand deeply. So most central banks have mandates associated with macroeconomic conditions, inflation, unemployment. They also have mandates related to financial stability and payment systems for some. And all these 3 can be impacted by physical and transition risks and how these risks affect supply, demand, capital allocation, profitability, liquidity, credit, and operations in general. So to the extent that climate shocks can have impacts on economic conditions, this is a topic that central banks need to monitor very closely, and depending on their mandates, need to act to safeguard the stability of the financial system. So what does the San Francisco Fed has been doing related to this? So our contribution to the issue of climate risks and their impact on the economy have been related to basically explore, engage, and educate. So we have been running surveys and roundtables and talking to businesses in the district that the San Francisco Fed is responsible for. We have been hosting a number of seminars and conversations like the ones that we are having here to better understand how businesses and consumers are reacting to such risks. And we have been also working on educated. So the San Francisco Fed has a research group dedicated to climate economics, and a lot of publications have been coming out of the team, and also from the engagement of this team with other researchers outside. So touching a little bit on the research, or giving just a little bit of examples of the research findings of the San Francisco Fed team. We have, for example, recently published a paper in which shows that negative weather shocks can have persistent effects on sales. So it's not that, let's say you have a negative shock and for that period sales are affected through the duration of the negative shock, But it is also the case that you can find evidence that over time, these effects are persistent on sales. Of course, this can have serious impacts on decisions regarding investment, inventories, capital allocation, and how you would be allocating labor across the country, for example. We did see also more recently in a survey that we run that businesses have been responding to climate. So it is frequent that we hear from business owners in our district that there is a big worry about regulatory framework and the uncertainty about what is the regulatory framework that is going to come related to climate-related issues. And in fact, the picture on the right-hand side shows a study from the San Francisco Fed researcher in which she estimates how much misallocation you can have of capital and labor due to this uncertainty regarding regulatory framework. So basically the idea of the research is to try to grasp on how much not being able to forecast what is the regulatory framework that is going to be placed is affecting the decision-making right now. And what she finds is that you actually have a big significant misallocation of capital and labor just because you are uncertain about the regulatory environment going forward. And these were just a few examples, and just to conclude, there are several channels through which climate risks and events can affect the economy. For that reason, this is a topic for central banks to understand better and understand the channels through which climate risks can affect economic conditions, labor, inequality, distributional effects, and so on. We have estimates, and I gave you a few examples, but we saw quite a bit of this throughout the conference this week, that there has been you can find significant effects of both physical and transition risks on macroeconomic variables, and we are already seeing households and businesses responding to these shocks and to the transition to a changing economy. Thank you.
Thank you, Fernanda. Harrison, over to you.
Thanks. Just hold on my slides here. Is that the full screen?
No, this next one, that one.
Great, thank you. Hey, thanks a lot. Thanks a lot, Rafael, for inviting me to the panel. I realized that Rafael was a Princeton graduate student. Fernanda is also a Princeton graduate student. I was in Princeton most of my career, so it's a little bit of a Princeton mafia in Barcelona today. I'm going to just kind of keep my comments really brief since I'm really looking forward to the panel. And I think Margarita and Fernanda did a great job of, both explaining why central banks should be involved and also, all the things that they're already doing. So I'm going to kind of keep my comments fairly broad in terms of, I'm going to talk about some properties of what I call kind of an optimal net zero transition. So this is definitely funneled through the view of a finance economist and a finance economist who's particularly enamored with Silicon Valley, right? So some of my comments will be a little bit futuristic, but hopefully, useful for thinking about the net zero transition. And I kind of preface my comment using the word "and" optimal net zero transition as opposed to the optimal net zero transition. Okay, so I'm interested in, most of my research, I think, in sort of this climate finance area is really on understanding these net zero portfolio mandates, right, that are meant to incentivize decarbonization of the corporate sector. Okay, and the most prominent examples are Glasgow, the Glasgow Financial Alliance, and of course this NGFS initiative. If you take seriously these pledges by these institutions, right, that's nearly 20% of global assets. Okay, so that's a huge amount of leverage that the financial system can muster in terms of incentivizing decarbonization. And the primary way this is going to work is going to be through a cost of capital channel, right? That the broad idea is that, look, if the central banks, and if the Glasgow Financial Alliance, these long-term stakeholders, can agree on a rule, a mandate, that says that companies have to do X in order to be qualified to be held in our restricted portfolio, right? That's a huge alternative to sort of trying to implement emissions taxes regionally, right? Because the financial system is extensive. It's got massive reach through the entire global system, and anybody who wants to be part of the financial system, any firm that wants to be part of the financial system to raise money via the financial system now globally, no matter where you are, needs to sort of play by these rules. And I think, you know, this is one of the few bright spots of I view kind of what has essentially been a very kind of pessimistic policy landscape in terms of addressing global warming. And I think a lot of the companies now are taking notice of these mandates because you see it, they're all proposing plans essentially on how to be net zero, right, in order to qualify for this quote unquote cheaper cost of capital. The example I have in mind here is like Microsoft, and this is sort of the Silicon Valley element, right? So Microsoft has a plan to basically go net negative actually by 2030. And if you look at the way most of the companies are going to do it, and this includes Tesla, Microsoft, Bill Gates, almost all of Silicon Valley folks, the way they think this is going to happen is, of course, you could do some conservation. There's a little bit of switch to renewables, but what most of these companies are envisioning is carbon removal, right? That you're going to invest in a set of new capital that we haven't had to invest in, right? Like reforestation, soil carbon sequestration, bioenergy capture and storage, and direct air capture. If you look at the most recent climate bill that was passed, right, the so-called Inflation Reduction Act, right, most of the climate pieces was essentially subsidies for this type of decarbonization capital, okay? And you know, I think that there's probably consensus at this point, even among IPCC, and you know, one can always quote IPCC. They have so many different reports, so you can kind of pick and cherry pick your quotes from IPCC. But I think kind of generally, the view is that, you know, scientists have been pretty hesitant to push in the direction of technology decarbonization to address issues because they worry about the moral hazard problem, right? That if you tell people, oh, there's going to be this technology that's going to suck up your CO2, you're not going to have any conservation. But I think kind of we're in sort of the game at this point that is pretty late in the game, and you know, if you scientists legitimately worry about some nonlinearities. You know, there is a risk out there of some nonlinearities in the climate system, and so they're pretty open now to using, you know, whatever tools are available. Okay, so I'm going to kind of preface, you know, think about the problem through this rise of decarbonization capital, and I'm not going to kind of so this is kind of based on some joint work. You can kind of download the paper, but you know, I'll just highlight some key properties. So the basic idea is the following: we're going to have a macroeconomy, right? We're going to have two types of capital. What we call productive capital, which is what we've been traditionally have, and then sort of this decarbonization capital, which we really haven't needed. And the role of this decarbonization capital, it doesn't do anything other than to suck CO2 out of the atmosphere. So we haven't really worried about it through most of the industrialization, but now we're going to start worrying about it. And you know, the model is going to do kind of the things that integrated assessment models do, but I think the bigger issue is really that we're going to be able to have a financial sector involved, which is typically missing in most integrated assessment models. And that's what I'm going to highlight is, you know, what are the properties for the financial system in such a net zero transition, okay? So I think I'll kind of do three properties. Property one is, think about, let's say that Margarita, the Banco de España, Fernanda, and all of everybody in the NGFS and Glasgow suddenly decide, what would be the qualification for a company to qualify for this quote-unquote restricted portfolio, right? Would they have to decarbonize 2% a year? Would they reduce 3% a year? There'll be some rule. Let's say everybody agrees on a rule. So I'm going to, essentially the optimal welfare mandate is going to be controlled in some sense and coordinated by the central banks, right? Of who qualifies for this quote-unquote cheaper capital source. First comment is, the standards are going to be becoming more stringent over time, right? That is, we're in the very beginnings. The banks are just beginning to kind of get started. Why is that? Because right now, there's not a whole lot of decarbonization capital. There's adjustment costs, right? It's going to take time to basically build up all of this capacity. But at some point, as this capacity builds up, it's easier and easier to require firms to do more and more to decarbonize. So this would be a gradual adjustment, right? We're in the very beginnings right now. It's pretty easy for everybody to say they're sustainable, but that will no longer be the case in 20, 30 years as more technology comes along, and it's easier to basically get firms to commit, right, to this reduction. Second property. In this model, it's important to remember, firms have a voluntary choice to be sustainable or not. Right? So we usually think about this as sort of being a dirty sector or not, but really the problem is way beyond like a dirty sector, right? It's really about reforming behavior at a manufacturing, broad corporate level, right? And so, ultimately there's going to be an indifference condition. Firms get to choose, right, whether they want to be sustainable or not. If they pay the cost to be sustainable, they'll get a cheaper source of capital, which basically compensates them for this decarbonization. And so there's a simple formula that we have, which just basically says that the difference in the cost of capital, what we call the cost of capital wedge, between green or net zero or sustainable firms versus non-sustainable firms is just simply going to be the annual spending on decarbonization divided by Tobin's Q. The Tobin's Q being the price of the productive capital, right? And that formula exactly kind of tells you that that's what you're going to be able to get each year in terms of decarbonization. So this is an analog to kind of the quote-unquote social cost of carbon, but really embeds the financial system as being pretty fundamental in terms of how we evaluate the progress. By the way, kind of one comment that people have is like, but if investors are going to be unsustainable, right, they're going to get this extra return, which is true. But in the long run, they're not going to dominate the economy because what's going to happen is unsustainable investors essentially just get to consume more, right? But the relative proportion of capital commitments gets to remain the same. So this is something that's sort of enforceable over the very long run. And the kind of final comment is that why is it that the cost, these sort of emissions taxes haven't succeeded? One answer is that if you really have this type of decarbonization capital that's available, there's not going to be one policy tool that will get you to first best. Right? You need multiple policy tools in order to basically align the competitive markets with the social planner. And so what we kind of show is that mandates plus some other investment tax will get you to first best in the economy. But the other thing also is just the mandates by themselves quantitatively do a pretty good job of getting you to first best. I mean, you're not going to get to first best, but if you believe some of the quantitative calculations, it's not a bad start, right? So all of this is basically saying that there's a lot, this notion of the movement of the financial system to impose these sorts of mandates is not, it's theoretically well grounded, okay? And I'll just kind of conclude with the NGFS, which is central banks, of course, have amassed this huge legacy portfolio of assets because of quantitative easing. Right? So just by pure accident, central banks are now a massive asset owners, right? And so now there's all kinds of interesting calculations, right, that come in because, there's obviously a lot of concern about inflation. As inflation comes, central banks may have to sell off some of these portfolios. But the good thing to note is that the central banks came in with a market neutral portfolio. So even if they sell, right, they can basically sell like, they can tilt towards green, in their selling behavior. So I'll stop with there, and thanks a lot.
Thanks, Harrison. Okay, very good. So now we could start a Q&A session, and please feel free in your responses to the audience if you want to also address some points that the other speakers also made in their presentations. So let's collect a few questions. Gentlemen up there.
Yes, good morning. I would like to ask to Margarita Delgado, in this new economic context, with the war in Ukraine, inflation to record highs, and even risk of recession, do you think this green strategy of central banks should be still a priority, or perhaps do you have to reconsider that in order to adapt to this new context? And by the way, if you see that there are any risk of the recession, and I don't know, what's your view on that? Thank you.
Thank you very much for your question. Very, easy one, of course. Well, maybe just a couple of reflections. First of all, I think it is clear that, for us, that inflation is under our mandate, right? Very clear. And also, sustainable and green policies. But, recently we've suffered extreme weather events, for example, and it is also clear that these extreme weather events expose our economies to probably greater volatility in inflation and in growth. Also, that we need to distinguish probably the short term and the longer term, in my view. So, indeed, my big question mark is what will happen during the transition. If we distinguish the short term, yes, you are right. We are in a context of kind of shortage of energy or cheaper energy in Europe, indeed. So probably we don't have enough renewable energies now in the very short term. But in the longer term, of course, there will be, and there is already, a shift to greener energy. And for sure, there, all those pressures will be reduced in the longer term. But in the meantime, there will be probably, energy shocks. So this is how to strike the right balance between the short term and the longer term. I think, indeed, there is not still very, very clear how, let's say, the green transition might lead to additional inflation. So I think that it is clearly under our mandate. As Harrison said, we are asset owners now, and we can really influence and have an influence and have a say through our quantitative, let's say, tightening, QT, and of course in inflation and also in the greener economy. But it is not clear how this will impact. And additionally, to me, what is really relevant is the design of the transition. As Harrison also mentioned, it is key how the transition plans of the corporates are designed. We have not, to the best of my knowledge, analyzed and assessed them yet. Indeed, we've analyzed the financial sectors, but they are, let's say, they are our figures, and their figures are based upon the corporates' figures and corporates' plans. So for me, what is really relevant is to have a proper view of the transition plans of the big corporates. But coming back to your question, I think this is very relevant, more than ever, that we have a role here. Thank you.
Thanks. Do you also want to share your views on this topic, or should we just collect a few more questions? Yes, please. Can you put your microphone on? Thanks.
Okay, now you can hear me. So my question is also related to the pressures related with the energy crisis. Because of the energy crisis, some investors have started perceiving the euro as weaker. So, and they have invested against it. So what can be done in terms of monetary policy in order to fight against these speculative attacks? Thank you.
Maybe let's collect 2 or 3 questions.
Hello, Luboš Komarek from the Czech National Bank. I would like to ask mainly two ladies, what will be the most effective international cooperation, among central bankers to solve this problem? Because it seems to me that you know, we have this in this activity of BIS, other central bank, Fed, and so on. But this greening issue is really, let's say, global one, and it seems to me that some international cooperation is really needed. Thank you.
Okay. My question is for Harrison. I think that's your name. I know that you talked about two different kinds of capital, and that made a lot of sense to me. But you opened up with the discussion of cheaper capital for green projects, and I guess it seems to me that as we saw with like smoking and gun-related socially conscious investing, that there are a fair bit of people who are happy to take a few basis points to own unpopular assets. And I was just wondering, do we know whether or not that's true? Like, do we have a sense of the realistic values of how much cheaper capital can be in this environment, and whether or not there is sort of, I don't know, like socially unconscious investing waiting in the wings to make this unprofitable? Thank you.
One more question, I think there was. Gentleman there, yeah.
Thanks. One of the points that was mentioned was about regulatory uncertainty around climate change. So in your opinion, what do you think could be the ideal regulatory and supervisory strategy for us to take?
Thanks. So should we start maybe from this side of the table, if you want to begin?
Sure. I think I'm going to touch upon some of the points that were raised, and then we can go from there. It is very unfortunate that shocks don't really go on a line and happen one at a time. You know, unfortunate for policymakers and for macroeconomists. So as much as we have other shocks going on, we still have the climate shocks happening and affecting the economy and affecting the decision making. So it is really hard to order things and prioritize what to put in the end of the line or the front of the line in some sense. So I think the comment by Margarita about, you know, thinking really hard about short-term and long-term, I think is really key. And the one thing that is very important throughout this discussion is the notion of mandates. So that goes a little bit into the second question about international cooperation. So I think sometimes we take a little bit for granted, actually, the benefit that comes from the BIS in terms of allowing for conversations and cooperation in terms of exchanging of best practices even across central banks. And that, I think, is already a key feature that, you know, central banks have, but finance ministers don't. And it shows in crisis. So we've seen it over and over again, how much central banks can speak similar languages and know what the other ones are doing really well. Whether they can do the same thing or not is really going to depend on their mandates, and central banks have different mandates. So it's really hard for anyone to compare what one is doing versus the other, because they are constrained by what they are allowed to do by Congress. So I think that goes into also these questions about how to handle assets as well, and it's going to be related to mandates. And finally, regarding the regulatory uncertainty, I think the point that the research has been showing is that the uncertainty is tilting behavior already, so you might as well have some resolution on that, and that is better than actually postponing and leaving it towards some other time in the future. In fact, I mentioned some of the research from the San Francisco Fed, but there is a recent research piece from, if I'm not mistaken, from the Kansas City Fed or the Dallas Fed. I apologize for not giving the proper reference here, in which they are showing how regulatory uncertainty is tilting the production of oil in the US. And despite the increase in price of oil, producers are delaying going back to drilling, basically, because there's uncertainty about what is going to happen to the regulatory framework going forward. So basically you have a massive oil shock going on. It is affecting inflation, but you also have questions related to the regulatory framework regarding climate and CO2 emissions that is tilting the production. And I'm not here to judge whether this is a good thing or a bad thing, but it's a fact that is affecting economy. It affects production and also inflation. So that's why in most of my presentation, I try to pass the message that it's really important for us to understand how these shocks and how the tilting behavior that is already happening is affecting macroeconomic variables.
Just picking up one of the questions. Well, on the euro attacks and the currency rate of the euro versus the dollar, what else can be done by the monetary policy? Well, I'm sure that yesterday you had the possibility to discuss it very, very openly and in depth. I'm sure that I'm not going to give you any kind of, let's say, I mean, the $1 million answer to the $1 million question. But of course, I mean, at the ECB on July, our monetary policy statement already stated that further normalization of interest rates will be probably appropriate. There will be a meeting next month, starting in September, and this will be data dependent. And of course, the currency rate will be an additional data point information that will be considered. So I'm not really now going to enter into, I mean, trying to really quantify what is going to happen in the future. I mean, there will be a monetary policy discussion, and of course this will be data dependent, and this all the path towards the normalization will be taken session by session and step by step. This is the only thing that I can say. On the coordination with the central banks, yeah, I think we are really I mean, coordinating all of our efforts. In what I tend to say is that too many things are happening at the same time. Sometimes, well, most of them are, let's say, very well coordinated, but there are maybe too many. If I were to say how many working groups or, I mean, international fora are we attending, I would say that the figure would go up to more than 50. So we have people including myself and the governor, working together in groups linked to the sustainable and the transition to a more sustainable economy in more than 50 working groups. So are they all well coordinated? Okay, probably not perfectly, but it is true that the whole community of the central bankers and regulators are really making their efforts in order to be very well coordinated. And maybe for the other question around the regulatory uncertainty for climate change, what is the right way on regulatory and supervisory strategy? I think we have just started to, to produce the first steps in terms of regulation. I think Europe is at the front page of, regulation globally. And also supervisors and regulators are following that path. As I said during my presentation, we've just produced a quite a deep and granular stress testing of the whole European banking system, around 100 institutions, being around 30 banks. The most advanced, the biggest, of course. None of them are up to the standards, so we have started to push the banks in order to have better information, more granular information to incorporate all the information into their risk management function, so on and so forth. And probably this is the right way to go beyond what is really strictly in the legislation. So I think that the strategy is clear. We've just started, and this is a long way to go, and we are at the very starting points. And also maybe just a few words. I mean, there will be technological changes. There will be consumption changes in the future. We cannot foresee exactly how and when, but I mean, I agree with Harrison that everything will speed up in the coming years, and I'm sure that we will be up there.
I'll just make, I thought both Margarita and Fernanda's response were more than adequate, but I'll kind of jump in with maybe two kind of minor comments. So first on the zero net mandates and whether or not that's executable. So I'll give you two pieces of evidence. So one is purely anecdotal from just sort of my sense of money flows in asset management. Europe has just played, and especially the ECB and the regulation of Europe, has just played this incredibly revolutionary role in terms of just affecting capital markets, even in the US, right? So you cannot really be a US asset manager and not now start worrying about these issues. And oftentimes, you know, I mean, this is a little bit of a naive psychological thing, but you know, sometimes looking is the first part of doing something, right? Because, you know, typically people don't look, right? They don't worry about these issues. And I think that as more light is being shed on this, it's pretty clear that the money flows are real, and they're more than enough, I think, to shift cost of capital. And the reason why sort of an anti-climate change sector is not going to come is, you know, ultimately, if you have a big enough pool of money, the cost of capital wedge is going to be pretty widely shared. You know, you're talking about at the in 20, 30 years, it could just be like 50 basis points, right? And that's kind of not quite enough to really have a massive sort of arbitrage, you know, short-term play. So just for all kinds of technical reasons in financial markets with liquidity, these mandates are executable. And certainly if Margarita and Fernanda and the central banks come in and design it well, right, including like, you know, if you're part of the restricted portfolio, the stocks don't get shorted, right, then of course it's a done game. You can definitely implement these types of mandates. So I'm pretty optimistic that it's implementable. I think on the question of inflation, you know, I think kind of the best evidence about sort of inflation in green, I think, comes from our U.S. Inflation Reduction Act, right? That, you know, our Senator Joe Manchin of West Virginia, right, has signed off on what are essentially a beginning of a green transition. And, you know, he would basically not do it absent if he was worried about massive effects on inflation. And I think the reason is the following. It's not so easy to just simply say, well, just because you're against fossil fuel companies, they're not going to be pumping oil, and therefore that's why oil prices wouldn't be lower, right? Because I think for these companies, in terms of their capital planning, right, that's many, many years on the horizon. I mean, I think Europe faces a natural gas problem. Hopefully it's one that will eventually kind of go away. But it's not so obvious that, you know, with the mass legacy portfolio of green assets that the central banks have, right, that if they begin kind of tilting toward sending some signals now, that wouldn't generate huge long-term benefits without very little impact, I think, on the short term in terms of, you know, the next 10 years. I think this is what the conclusion of this Inflation Reduction Act in the U.S. has concluded. And I think, you know, calculating the impact of policy on inflation is quite complicated, right? There's a lot of moving levers in terms of what happens when you impose these taxes, because there's also some burden sharing that happens between corporations and also consumers as well. Okay, thanks.
Thank you. Okay, so we have 3 minutes left. So if there's a quick question, we'd take 2 questions. I ask you kindly to keep them short, and also if you could also keep the responses short, it would be helpful.
Thank you. Yeah, my question is, when you said integrating minimum standards to the central bank's in-house credit assessment systems, are you also taking into account biodiversity considerations and double materiality? And another very quick question is, now with the increasing interest rate and kind of revival in fossil fuels, there is is there a concern that the cost of green investment is going to also go up? So what can a central bank do beyond kind of integrating climate and environmental risk, for example, more proactive steps, innovative financial instruments, as, for example, in terms of green credit guidance?
Up there, please. Thank you. Kindly keep it short.
Yeah, I think the question is about the impact of climate change, not only on corporates or banks, but on households and therefore also on governments. And you know, what I don't understand why we're still holding on to a zero risk weight for governments in these times where, you know, obviously the reflex of the governments will be to spend significantly more money to ease the impact of climate change and also ease the impact of the economic war Europe is currently in with Russia. Thank you.
Thanks. So very interesting questions. So I invite you in 1 minute to answer all of them. Each. Who wants to start?
Well, yeah, maybe for the double materiality, of course. I mean, this is a question for assurance and auditors. But of course, I mean, we have worked, indeed, I can say personally, very recently, at a global level, I mean, in order to really have a kind of, roadmap to really gather together, starting with the big four auditing firms, and in order to have a kind of agreement at a very global level. But of course, the international standards and initiatives are key to be successful in this implementation. And our internal ratings are, of course, are using, as Rafael already showed us in the previous presentation, are using, of course, public information and the disclosures that are already, let's say, in the markets done by companies, corporates, and financial firms. So we need to be very clear and pushing, I mean, all the different parties and agents that are involved in order to have, let's say, common standards, I mean, and comparable information. To me, this is very relevant for decisions to make in the future. On the I can't remember exactly, well, on the impact on climate change and on governments and risk weights, I think this is a very complex issue in order to be answered in just 1 sec. Yeah. But I mean, there is another element that you've missed in your question, which is the tax and the fiscal policy around, I mean, the green transition. And I think this is an element that we need to consider here. I don't see that this should, of course, be considered as a part of the risk weighting. It's just as a whole. I mean, it's, of course, for some countries there is a need of fiscal consolidation and a clear plan for the future. But this, I mean, in order to really answer to the whole question, we need to consider all the elements that are involved here in the green transition.
Want to add something?
In 1 second, I think the one issue that was raised in the questions and we didn't really have time to talk about is I mean, I mentioned the effects on households and firms, but on the effects on households, you do have some distributional effects as well. And so that came as a question, and for sure these are relevant for economic conditions going forward. So it is unquestionable that depending on income levels and wealth, you're going to have some different impacts of climate-related events.
Yeah, I mean, I was going to say that these net zero portfolio mandates, one of the attractive aspects of them from a political economy perspective is that, you know, they're not obviously as regressive as like a straight emissions carbon tax, right? Because presumably what these mandates are doing is implicitly a tax on asset owners, right? And the asset owners are fairly, you know, people who own assets are fairly rich, right? And so, of course, there's still going to be some incidents in terms of burden sharing, right? Because some of that will get passed on to prices for consumers. But it's certainly, I think, one reason why you're beginning to kind of see globally, even in the US, which is pretty obviously behind Europe in terms of the transition, kind of favor these types of schemes compared to a straight, in the Biden administration, the words carbon tax are not allowed to be spoken, right, for these reasons.
Very good. So this brings us to the end of this session. So let us conclude. So thank you very much for listening and for your questions. And join me in thanking the panelists.